Hi everybody, Thomas here. It's time to go over a new stock highlight. Today we're going to go over a company that a lot of you may be familiar with, one of the biggest pharmacies in the United States, CVS. Take a look and determine if this is a stock that represents a big bargain at its current price, or is it one of our proverbial sucker's bets. Let's dive straight in. This is a stock that, as we can see, has been following a pretty strong downward trend for most of the year. In fact, going all the way back to the spring of last year when it topped at around $108 per share or so, and it's pretty much been following a downward trend from that point. About a month ago, though, it did reach a bottom in the mid $60 range, and that is something that looks like it could be giving the stock a little bit of a lift over the last few weeks. It's rebounded above that point, and it is now sitting a little bit above $71 per share. So this looks like it could be an interesting opportunity, especially when you think about it in context of the kinds of technical patterns that I've built Rebel Income to focus around. This is looking like a really interesting bullish 2 kind of setup. Just to revisit really quickly, we want the 200-week moving average, which I marked the bullish level 2 pattern by focusing first on the 200-week moving average on my chart, which is shown by the blue line, which will generally be going up or may possibly be starting to flatten out, which in this case we do see. The 20-week moving average, which I mark with my green line on my chart here, will have been going down and dropping below the 200-week moving average, but it should also be flattening, possibly starting to bend upward in direction. Right now it's starting to flatten out, in fact, and we're starting to see some really interesting price action based on our candlesticks. Over the last 3 weeks, we see first it was marked by what I would call an engulfing candlestick, which is this large open candlestick, which represents a lot of bullish activity in that week. The week after, it formed a inverted hammer, meaning that the hammer end of the candlestick was on the lower end of the price action for the week, but it was still a hammer, and whether or not it's inverted or normal right side up is really a little bit less important. And this week it is starting to form another kind of inverted hammer, but is also a little bit above the level that it was at last week. So this is a very interesting pattern that fits nicely into the bullish level 2. So I'll just write BL2 on my chart here, kind of technical pattern that we like to look for. This does beg a lot of other questions. How much upside is there? Are the company's fundamentals strong enough to suggest that the stock should be worth more than its current price is showing? If that is the case, then we may be looking at a very interesting combination of value plus an interesting technical setup. Let's go ahead and take a look. Here's the fundamental profile for CVS. As you know, I like to pay attention first to free cash flow. In this case, we have a pattern of decline over the last 12 months. A year ago, free cash flow was about $19.5 billion. In the most recent quarter, it was about $17.6 billion. However, it has increased from the last quarter, from about $17.4 billion to the $17.6 billion. So a little bit of an increase over the last quarter, a little bit of a decline over the past year. That's a little bit of a mixed signal, but at the same time, the actual free cash flow number at $17.6 billion translates to an overall free cash flow yield of a little over 19%. That's pretty healthy, even if it is a little bit lower than it was a year ago. The pattern of cash over the past year is following essentially the same pattern as free cash flow. We see that it was almost $20 billion a year ago and is now sitting at about $16.9 billion today. It's also a little bit lower than it was in the most recent quarter, $17.7 billion compared to about $16.8 billion. So down by about $900 million in the last quarter, spending a lot of their cash, presumably in the form of capital investments, for example. CVS is investing pretty heavily in reformatting most of their existing pharmacies into a combination pharmacy and health service location, which they call minute clinics. That's a long-term process they've been going through for the last couple of years, and they continue to invest very heavily in. Their level of debt is also pretty high at about $61.4 billion, and this is also higher over the past year compared to $50.8 billion. This is a company that in 2019 also took on quite a bit of long-term debt associated with their acquisition of health insurer Aetna. And so that is something that they are still working through, the merging of their pharmacy business with their health insurance business, so that two very disparate organizations can operate together as a single organization. That's another process that takes time, and servicing the debt associated with that acquisition is also something that is expected to take a number of years. Now, despite those things and some of the mixed signals that perhaps we're seeing in terms of growth in free cash flow and in terms of overall cash over the past year, CVS does have an interesting operating profile. This is a company that has operated with historically narrow operating margins. Over the last year, net income divided by their revenue over the same period was a little under 1%, which implies they really have very little margin for error when it comes to operating on a profitable basis. Over the last quarter, however, that number increased to about 2.14%. Now, maybe that doesn't sound like a whole lot, but when you compare 0.83% to a little over 2%, you're talking about an increase of more than double what it was a year ago. And when you're talking about operating margins that are going from that narrow to even to 2%, a doubling of those operating margins does give the company a lot more cash to work with, a lot more financial flexibility to work with, and along with the generally healthy levels of free cash flow and cash, certainly do enforce the idea that servicing their long-term debt, even though it is pretty high, it's almost $61.5 billion, it should be no problem. Those are all important elements that help to put the overall free cash flow number in a broader perspective to determine whether or not the debt is onerous, whether it's going to be burdensome, or whether it's something they're going to be able to manage. This is a company that also pays a pretty nice dividend at $2.42 per share against their current price at a little bit above $71 per share. That means their dividend is about 3.4% roughly, which is pretty nice. The really interesting thing about all of this is that altogether their fundamental profile is pretty strong. There are, as I mentioned, some mixed signals, but they have a very healthy balance sheet. They are operating on pretty solid financial footing. And when you put all of that, factor all of that against what the stock's downward trend over the past year has done, it's really put the stock at a very interesting value point. My basic valuation metrics suggest right now that the stock's fair value target should be at around $171, a little bit above that point. That means that this is a stock with more than 140% of upside. In other words, almost 1.5 times its current price. That's really interesting and would generally categorize this as a very impressive bargain buy. Now, that gives you an idea of what the overall fundamental profile looks like. Let's take a look back at our chart and let's see where some of these numbers compare against where the stock's technical setup currently sits. The stock is already forming a pretty interesting bullish level 2 pattern. One of the first questions you should ask yourself is, where is the stock going to find next likely resistance above its current price? Right now it's sitting a little bit above $71. We do see a previous pivot high in the early part of August of this year at around $75, almost $76 per share. So that's about $4 above the stock's current price. If it can break above that point, it should find next resistance at around the 200-week moving average, which is at around $80.50. So I'll put 80.50 here, and I apologize for my really bad handwriting. Now, as I mentioned, the stock's fair value target is about 140% above the stock's current price, so more than double at around $170 per share. We can see that's certainly well above even the high of the last 52 weeks, which is at around $108 per share. So that may be a very long-term target that looks pretty interesting, but it's going to take some time to get there if the stock can begin to reverse this downward trend. But we are looking at some interesting opportunity levels for the stock based on this current pattern. If it can reverse this upward trend, there is certainly some interesting upside to be had. The next natural question should be, how much downside is there? If the stock doesn't maintain its current pattern of bullish momentum over the last month, how far could it fall? What if it actually reverses? Next level of support for the stock is right around the 20-week moving average right now, which is at around $70 per share. Again, I apologize for bad handwriting here, but $70 per share. If it breaks down below that point, then its next likely support is going to be at around this pivot low level, which is at around $65. Now, what that means is that in terms of reward to risk, we have up to that first level of resistance at around $76. We have about $4 of upside. That's going to be our $4 of reward. That's to the most recent pivot high at around $76, against about $1, a little bit over that, I'll put $1.30 of risk. That's back at current support at around $70, just a little bit above that point. So reward to risk here is 4 to 1.3 rate, basically. So we're talking about reward to risk that is more than 4 times higher than what you would be taking risk on, even on a very, very short-term trade. And in terms of long-term opportunity, it certainly looks like there's a much greater level of upside opportunity in the stock compared to what its overall downside is, considering the overall fundamental strength of the company. When you put all of that together, that means that CVS really does look like a great big bargain right now. I hope you found this to be helpful. If you do like it, please go ahead and subscribe to my videos. That way you'll get a notification each time I publish a new video on my channel. I appreciate your time, and we'll talk again soon.